Okay, welcome everyone. We'll start our second lesson on financial decision making. So during our first lesson, we learn about our LO1, which we discuss about analyze the factors that guides and drive the decision making. We discuss about why we need to make a decision. Decision making is means selecting the course of action from various alternatives. So I discuss with you financial factor that business need to be look around, and we discuss various types of risks. Under LO2 last lesson we discuss about accrual and cash flow approaches. We discuss about accrual is a matching concept. The financial statement should be recorded on the accrual basis when the income and expenses anchored, not when we receive the cash. So that's we discuss. We normally don't do the cash accounting. We do on the accrual basic accounting on historical cost. So then we discuss about structure and the contents of financial statements. I mentioned here how many types of financial statement we prepare in accounts, which we mention statement of profit and loss, which also known as statement of comprehensive income. I mentioned your statement of financial position, which is also known as balance sheet. I mentioned you in the last lesson statement of uh, cash flow statement, and I mentioned your different financial ratios, four categories of ratio: liquidity, profitability, use of resources, and gearing ratio. We discussed during last lesson. We discussed about difference between the financial decision relating to capital expenditure and the revenue. I mentioned you the capital expenditures mean those are the long-term expenditure, those spend money towards non-current asset with no, those are known as the capital expenditures. If you extend your house and which increase the value of the house, that will be clustered as a capital expenditure. Revenue expenditures is day-to-day expenses. Those will help to maintain the asset in the same condition. And revenue expenses goes in the profit and loss, and capital expenditures is part of balance sheet. So that's what we discussed during last lesson. Today we are moving forward and we'll go through today. Today I set the lessons according to assessment criteria. So LO3, be able to perform effective capital expenditure appraisal using range of techniques. So appraisal means checking the performance. So we'll check the performance, the money we are spending towards capital expenditure, like the non-current asset we are spending. So what will be short or long-term sources of finance is available to borrow the money from, and why is a short term is better than long term, or long term is better than short term. So we need to appraise them in terms of the cost, in terms of the performance, in terms of the long term commitment, and what impact will be on the organization. So that's will I'll go through today. Critically examine the key factor affecting the choices. What are the key factors that are affecting? So there are the various economic factor like micro environment, pest, political, economic, social factor. Those affect the sources of finance plus the organization long-term commitment. So which will go through evaluate the various techniques, which will go through various appraisal or appraisal methods. So those will we can use to measure the performance in terms of when we investing the money as a sources of finance. Explain the possible benefit and drawbacks of balance sheet, the things which we are not showing on the balance sheet. What are the advantages, what are the key disadvantages, what are the legal requirements, why we're not showing on the balance sheet those things. So that's we'll go through, and then LO4 will be last hour, which we'll go through today as well. Critically analyze, compare, and analyze the corporate governance and legal regulatory environment. Corporate governance, how will regulate, how will govern the organization, that will be a bit discussion. We'll go through stakeholders, what their interest. Different stakeholders. Stakeholders mean anybody who has any interest in the business is called stakeholders. The shareholders are the investor. All shareholder can be a stakeholder, but not all stakeholders can be a shareholder.
Yes.
So return on capital employed and EPS, which is earning per share, which will discuss how we can measure and what are the advantages and disadvantages for business and the long-term sustainability. So Then we'll go through the differentiate between the business ethic, governance, and business ethics and control on the business accountability. So all will be in our discussion. So when we'll go through, so technically we're supposed to address all the key points here in terms
Yes.
of and please, when you prepare your assignment, all these assessment criteria, you can pick the things, from here. I'll try my
Okay.
best to be discuss and go through all the keywords, the buzzwords and their meanings, but you can go through as well yourself, because sometime in the lesson is very difficult to address everything, but I'll go through and explain you very basic, good understanding. If you have still any question, please get back to me and I'll try my best to send you extra resources to address, all the issues and
Sure,
to
sure,
address the learning outcome.
sure.
Any question, Deepak?
No, no, not so far, not so far.
Okay, brilliant. So we'll start. Okay, welcome everyone. Those are listening this recording. My name Anjum Sattar and my email address is there. In case if you need me, just drop me email. And today we are doing our lesson 2 and we'll go through LO3 and LO4. So LO3 is be able to perform the effective capital expenditure appraisal using range of techniques. So we'll go through the range of techniques, those we can use to appraise it. And then LO4 will go through different ownership structure, which I already mentioned in LO1, but we'll go through the impact on the financial performance. And what do you know about the stakeholder and sources of finance? Any thoughts, Deepak? What do you think about?
Stakeholder, as you said, that anybody who has an interest in the business, okay,
Yeah.
and the source of finance is from where the fund coming, the fund like investment comes from.
So
Okay.
less about when you borrow money yourself or ourselves. So what do you think? What we need to look around? What factor we need to look around?
Uh, yes, the why we need the money and from where actually the maybe can be bank, can be finance, and can be anyone.
Okay.
Okay.
What else we need to look around?
And also the business for what we need finance, the
Okay.
money.
One key thing we need to look around, the cost and the time.
Cost and time. Okay.
Because the cost, how much is the interest rate I
Oh
have to
yes,
pay?
I have to pay. Yes, we always have to compare the the interest rate. Yes, this is very important. Yes,
And
and
how long I'm committed
to pay back. Yes,
payback. Yes. So
yes,
these are the crucial things, yes, for the
yes,
business
very.
world especially. Okay. So now we'll go through today because your assignment will be based on these assessment criteria. So I divide my discussion and today according to assessment criteria. Hope so will help you when you prepare your assignment as well. But we don't need to restrict on these points. You can expand your discussion.
Yes.
Okay, so appraise various sources of short-term and long-term finance. Short-term, any finance which we need for 12 months, we cluster as a short-term. So short-term can be overdraft. Yes.
Okay. Yes.
Short-term can be for anything we like invoices, we can discount if we have a customer invoices, but we don't have a money, we can take to the bank, we can discount it. Bank, if we have a customer, we're supposed to receive £100. Bank maybe will say, give us this legal document, I'll give you £80, I'll kept it.
Mm-hmm.
So that's
Okay.
called, short term.
Yes.
So financial management is concerned with the efficient acquisition and deployment of short-term and long-term financial resources
Mm-hmm.
to ensure the objective of enterprise are achieved.
Mm-hmm.
So we need to go through this, and decision must be taken into three areas. So when we'll make the decision, we need to look around the investment, both long-term investment in non-current asset and short-term investment in working capital.
Yes.
Working capital we discussed during last lesson, which is known as a running capital.
Yes.
which is it's come under the current asset. We discuss about inventory,
Yeah.
receivable, prepaid. These are all our short-term asset, which is short-term finance. We receive short-term finance for short-term asset. If we
Yeah.
need to buy a stock, we don't have a money, we can buy. We can use the short-term sources of finance.
Yes.
Finance from the sources should be fund be raised, and dividend. How should the cash fund be allocated shareholders, and how will be the
Will.
value of the business be affected by this?
Yes.
Any question?
No, 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 not so far.
Okay, so next now. Next, we're looking the sources of finance can be debt and equity financing.
Mm-hmm.
Debt is mean we borrow money from the banks, various financial institution. Equity
Okay.
mean we issue shares to the public to raise the finance.
Yeah, like we sell shares. Yes. Yes.
So the shareholder have a voting rights.
Mm-hmm.
They can change the management if we have ordinary shares.
Mm-hmm.
So we need to look around if they change if we issue more shares, it means we are putting our job at risk as well.
Yes.
And we're losing the control. And
Yes.
we need to pay the dividend. And the
Okay.
dividend always higher than the debt, the interest rate, because the shareholder want more than if they deposit money in a bank is a less risky. If they deposit or buy shares is more risky.
Yes.
So they want more return. In business, we say higher the risk, higher the return.
Exactly. Yes.
So we always looking the debt and equity financing. So
Mm-hmm.
according to the various authors, always debt is cheaper than equity.
Yes.
So lot of in a list says we need 60% debt if we need to, and 40% equity will issue to the public
Yes.
as a share. So we don't have control issues, and debt is cheaper than equity. But debt as a fixed term commitment, if you
Mm-hmm.
don't pay it, it carry on increase more interest on it.
Yes.
Equity, if you don't pay, if you don't earn it, you don't pay to the shareholder, but maybe shareholder will be disappointed. Yes, but you're not committed to pay them.
Yeah. Yeah.
So that's also sources of finance we can decide basis of the cost of capital, capital structure which is already in the organization, and the risk factor.
Yeah. Yes.
So money in through sources of finance, then the company buy the asset, money out from the business.
Yes.
Money out can be goes towards working capital, towards investment in the non-current asset, and towards dividend.
Yes.
So we need to look around the investment appraisal and working capital management. So working capital is a short-term decision, and the investment appraisal is a long-term decision.
Yes.
Any question?
No, no, not so far. Yes. Clear.
So the link between the financial management and corporate strategy is very important. So when we decide, we need to look around what is our mission.
Okay.
Mission is overall objective of organization why we are in business.
Mm-hmm.
So broad-based goals, we need to look around detailed objective targets. We need to look around the strategies and the commercial and the
Yes.
financial.
Yes.
We need to expand into new market, or we want to be return on capital employed we want, or organic, or we want to grow in business. We need more money.
Yes. Yes. Yes.
So
Yes.
acquisition of new equipment, if we are acquiring, we return on project return. We want to lease it or we want to buy it.
Okay. Yes.
So maintain liquidity level is mean mostly asset level. Cash level we need to be receivable in days, how many days, and the credit or the cash of delivery all we need to be managed.
Yes.
Then next we looking the financial objective. Always we have in a business shareholder wealth maximization in a fundamental financial management our objective when we'll make a decision. Many
Mm-hmm.
other objective we need to look around in the business profit maximization,
Growth.
growth, market share, and
Sales.
social responsibility.
Yes. Yes. Yes.
So it's very crucial we keep in mind when we'll decide, the sources of finance.
Yes.
Then in the long run, we have investment appraisal. Investment appraisal is a business concept, which means the money we'll invest today, what we'll get in future. What will be real value? If I'll have a pound today, is more worth if the pound will get after 12 months.
Yes.
So we need to appraise it. If you get the quicker cash, is the better. So different investment appraisal method we use: payback period, discounted payback, net present value. It means if we have a pound today, what will be the net value after depreciating the value of the money? Internal rate of return, how much is it cost me, how much I want, what is the market, so what will be actual real interest. Sensitivity is means some project can be very sensitive, very risky, so we'll do sensitivity analysis. Break even is a point where the no profit, no loss. We can use method to calculate as well. Accounting rate of return, what I will get actual rate of return.
Yes.
So all we need to look around.
Yes.
Okay. Now next is 3.2, our assessment criteria. So next we'll go through and critically examine the key factor affecting the choices. When we're looking the sources of finance, key choices will affect by the cost of finance. One bank is giving me 0.5 interest, other is giving me 2%, other is giving me 3%. So I'll always go through the lowest one.
Yes.
One is giving me more money, one is giving me less money. One giving me long term, one giving me short term. Yes.
Yes.
My need and what they're offering, I need to match as well.
Yes.
So what effect will be on financial statement if I'll borrow money through debt? Debt will go on the statement of profit and loss, because interest on it I need to show and the liability I need to show in the financial position. But if I'll go through equity, equity is mean the shares. Shares will go in the balance sheet, and the cash which I'll get is goes in the balance sheet as well. So no effect. I need to look around when I'll borrow money, what benefit will be toward the tax as well.
Yes.
So if borrow money, debt financing, debt is on the interest is expense for business, which I can reduce my profit and I have to pay less tax.
Yes.
So I need to look around all these sort of options to make a decision. So which option is the best?
Yeah.
So both short term and long term. Any question?
No, not so far. Not so far.
Next, we also we need to be look around critically political situation, economic situation, social and technological. Like if I want to borrow the money, what's going to happen? Brexit. We want to stay in the European Union or not? What effect will be on the economic activity? I need to decide, to be.
But in some country we will have to go for the legal, like pestle. We talked about the pestle also. What do you think?
Yes, we need to look around as well, of course, So we need to look around the political stability. We need to look around the tax policies. We can look around forthcoming legislation, employment law, dominant political ideology. Some can be against foreign investment, some can be, and if we want to expand it, can be risky.
Yeah.
So we need to look around economics. We need to look around the inflation rate in the country. We need to look around the exchange rate. We need to look around economics growth. We need to look around the taxation. We need to look around unemployment rate. We need to look around per capita income, per person income in the country as well. Before I want to expand my business or not. Because home I want to borrow the money and I want to expand the business.
Yes.
Social, I need to look around economics, living conditions, trend in fashion, religious and employment pattern. Under technology, I need to look around investment. I need to look around changes in information technology, changes in mobile technology, speed, and impact on technologies on business. So that's all come under.
Yes, I got it.
3.2. Next, 3.3. 3.3. Evaluate the various techniques used to appraising, making decision regarding the capital expenditure. Always capital expenditure mean non-current asset. So when we do the non-current asset investment, buying new asset, So always we need to look around the payback. We are buying the machine. How long that machine will cover my investment which I'm investing?
Okay.
Discounted is mean the money we had invested today. We need to look around the real value of the money which we'll get in future.
Yeah.
Net present value is also real money, like earlier I mentioned in other LO. Yes, and
Yes.
assessment criteria. So we need to look around all these factors. Then maybe we can look around if I'll use the payback period method, have advantage and disadvantage. Payback mean what you invest, what you get, how long will takes you. It's very simple. I invest £100. How long will takes me £100 to get back?
Yes.
So simple to use and easy to understand this method, quick solution, preference to the liquidity and useful in the case of uncertainty. If you
Yes.
get the quicker money is better, yes?
Yes. Yes.
But this method is ignore the time value of money. If I'll say you will get after 1 year, but after 1 year, what will be the value of that pound? Is ignore this method is not. This method is only looking what you pay, what you get,
That's it.
but not looking the real value.
Yeah.
Not all the cash flow covered, not realistic, ignore the profitability and neglect on the project return. So if
Yeah.
the total cost of two projects A and B is 12,000 each, so cash flow from the project generate each year is 3,000, 4,000 respectively. Payback period for A is a 4 year and payback period for project B is a 3 year. So which
Yes.
one will go? Will go for 3 instead of 4. Yes, we'll go for project B instead of project
Four.
A because project B is a shorter, project is a longer.
Yeah. Yeah. Mm.
Any question?
No. No. So far. Oh.
Okay, next we're looking NPV. NPV mean the net present value method. If we have a present value of future cash flow, will we get? If it's come positive, we accept the project. If come negative, we reject it.
Okay.
Okay, so exemption of reinvestment we have. Accept the conventional cash
Cash
flow
flow.
pattern, how often we'll get. Consider all the cash flows. In this method, we'll consider all the cash flows. We not restrict until what you invest, what you will get. Like investing money on education is a flow maybe forever. Yes, the money
Yes.
or the return can be forever. So we need to look around short term and the long term perspective.
Yes.
So good measurement of profitability and factor of risk also measure under this method because we're looking the real value of the money, not in term of disadvantage is it's based on always estimation. Opportunity cost, ignore the sunk cost which can be sunk, which we can't recover it. Difficulty in term of determine how much return, yes?
Yes.
Because we always use the estimation and estimation can be based on various factor and can be wrong.
Yes.
So it might not boost the EPS. EPS mean earning per share or return on capital employed. So that is other problem in this method as well, advantages and this one. And it's a very difficult, if I'll say you time value of money, time value of money. So people say, what the hell you talking about time value of money? So we need to look around, people will say, why this guy is using this time value of money? Okay, that's why if you're a financial analyst, you're thinking always you borrowing money to someone and you're thinking if you're borrowing money to someone because you're losing the opportunity to invest in another company. Yes, so we need to look around and you're looking the money that somebody, if you're giving somebody £20, you're getting after a year £20 back. Actually you're not getting £20, you may be getting only £15 in real value.
Real value. Yes.
So that's all about, huh? But it's very
Yes.
difficult to explain someone.
Yeah.
Any
Yeah.
question?
No. 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 Okay.
Okay, the next we are looking now is explain the possible benefit and drawback of balance sheet 3.4. So off balance sheet financing refer to any arrangement in which the business obtain fund or equipment from external sources but does not report the transaction as an asset or liability on its balance sheet. This is called off balance sheet. However, the business may be mentioned the transaction in the notes For example, instead of buying a new equipment, the business maybe choose to lease it. It does not become an asset or liability. Off balance sheet finances are several advantages. Okay. Any question?
No, it's fine.
So then next we're looking explain the benefit and drawback of so the previous learning outcome where we discuss explain. Yes. Here we're looking
Possible, yeah.
it's the same, so we need to look around. A business usually does not have include an item. Yes.
Yes.
Off balance sheet, we look around either asset and liability. What are the advantages? Are borrowing capacity. When the business takes a new loan, it increases debt burden. With the off balance sheet finances, the business obtain the funds or the item need without affecting the debt burden.
Yes.
Because a business usually has a maximum amount of funds it can borrow. Off balance sheet finances give the business ability to use the remaining allowable borrowing capacity for other purposes. In the way, off balance sheet finances allow the business to accomplish more tasks.
Yes.
Does it make sense?
Yeah, it makes sense, yeah.
Okay, great. So relationship. When business sign a contract with the supplier or the lender, the contract may be required the business limit its debt to the certain level. If the fund needs to be or equipment decide to take a new loan, it may be exceed the contractual limit. In
Yes.
case of large corporation, business also have to obtain the approval from the director for new debt because our balance sheet financing does not involve the business taking on debt. It does not affect the business relationship with the supplier and lender or the director
Yes.
because we're not showing them. Yes.
Yeah, we know, so yes.
Any question?
No, not so.
Okay. Next is maybe a bit hard to read your end, but you can expand it. Yeah.
No, yeah, we can do it. Yes.
Professor Charles Kennedy Handy, he actually gave they compare and contrast the stakeholders' interest. So owner interest to maximize profit.
Mm-hmm.
Yes.
Yes.
So employees interest to be get maximum salaries.
Yes.
Customer interest to be get the good quality goods and cheaper product, value
Yes.
for money. Suppliers, they want, make sure they will get their money on time.
Mm-hmm.
Finance providers, they want, if they are giving you borrowing money and they will get a higher interest from you.
Yes.
Government want to earn the more tax from us.
Mm-hmm.
And the community at large, they want, organization provide the jobs for local people and boost the local area.
Yes.
So here always we have a conflict. I want profit more. You employees want more salary. So how will balance their interest? Yes.
Yes. There are lots of things.
So always we need to look around because always we have a conflict. So like government don't have a money, but the doctors want more salaries.
Yes.
So we need to look around how we'll balance it. Yes, we listen them. Somewhere we need to agree.
Yeah.
So that is compare and contrast the stakeholder interest, owner, and then we need to make a decision. Any question?
No. That's fine.
Okay, for this I copied the link for you on the next slide as well. That will help you.
Okay.
So you can, when you prepare your assignment, you can. So next we're looking 4.2. Next we're looking 4.3.
Mm-hmm.
Evaluate significant return on capital employed and EPS, earning per share, overall measures in the long-term sustainability of business.
Mm-hmm.
So if the business don't have a return on capital employed, business can't be sustained for the longer period of time.
Okay.
ROE, we can calculate net profit divided by the capital employed. Capital employed always equal to total asset less current liabilities and less equities plus long-term debt.
Okay.
So that's the formula we can. During first lesson we discuss all the ratios which is given there as well, which is very well explained there as well.
Mm-hmm.
So we can use the formula this to calculate, and we can see year by year what's happening on return on capital employed. Return should be goes. If like in the food industry, some people say if you want invest £1 is you will get 400% return. You will get if you want invest £1, you will get £1 return back. Some say 100% you will get back in a year. So we can compare it. Yes, return.
Yes.
Some industry you will get very narrow return. Some industry you will get more return. So this method is easy to calculate, figure your readiness available, measure how well the business is utilizing the funds, and often use the external. Some company they have £1 million worth of asset, but they're generating very little profit. Some they have a very little asset, but they're generating more profit.
More profit, yeah.
So that's we need to look around, because some countries very rich in the natural resources, but they are very poor.
Yeah. There is a lot of
Like Venezuela is struggling. They have a rich in oil, but they can't afford it to offer the food, for their public due to the poor management or utilization of resources.
Yes.
So we need to look around. Research show the poor correlations, yes, and there are advantages and disadvantages. When we'll go through next now. So next is we can look around again. EPS, earning per share. Earning per share is mean the profit after tax and divided by the share, how many shares we have. Any question?
No, it's fine. This profit after tax. When we get after
tax, because the share, the money goes to the shareholders is after tax, yes?
Yes.
So after tax and the number of shares, or we can use the average, weightage average period.
Yeah, it's per share.
And different values, huh? Any question? And both have advantages and disadvantages.
No questions, yes.
So next are 4.4. Differentiate between the business ethics and the governance and accounting ethics, yes? What is meant by ethics? Ethics is mean the moral principle.
Yeah, moral conduct.
Moral principle. So normally in an ethics point of view, we'll use the business ethics. So I'll add one slide here for you more. So we use the word popular people chat in offices, PPCIO.
Yes.
So popular people chat in O stand for offices, huh?
Offices, yes.
So first P stand for professional behavior. We always need to keep.
Yes.
Professional competency.
Yes.
And due care. Due care, it's mean up to date knowledge. Yes, because the skills, like if you're accountant, you need to be up to date your tax rates. Yes.
Yes.
Legislations. Next, C stands for confidentiality. We need to keep the client information confidence. Yes. Next, I stand for integrity. Integrity mean honesty.
Honesty.
We always need to be honest with. Yes.
Yes.
So next, O stand for objectivity. Yes.
Yes. We should be aligned with
the profession.
Yes, with the goal. Okay.
Yes, with the goal. So these are the 5 professional code of ethics as accountant we need to follow, and these come under ethics. Yes.
Yes. Thank you for this.
And always to remember it, we call popular people chat in FC. This is the abbreviation of professional behavior, professional competence, confidentiality, integrity, and objectivity.
Yeah.
Okay. So we need to governance is a major issue of director, how the director will govern the company. Social responsibility, CSR, we are responsible of 3 things. We are responsible of profit in a business, yes.
Yes.
We are responsible of planet.
Planet.
We need to care about environment, and we need to care about our people.
Yes, now in every business, these three things comes under the main objectives.
Yes, so we need to be this objective, we need to fill, and we need to look around. If we don't do it, it will relate to risk for sustainability in a business, and we need to be accountable people against these. Okay, next we're looking now what is the ethics and why the business is. So when we're looking the ethics for the organization, good ethics should be seen as a driver for the profitability rather than as a burden. For individual, consumer and employees, expectation have evolved over recent, yes?
Yes.
So we need to fulfill an ethical framework, good corporate governance, how well you govern, how well your implies representation in the board. If like in some directors getting million bonus, but the employees not getting, we need to play the fair shares.
Yes.
So that's all about the ethics, and that's all about our learning outcome, which we're supposed to for learning outcome 4 and learning outcome for 3.
3, yes.
So all been explained under assessment criteria, how we can and what are the key points. So when you do your assignment, you can explain them in your own words, and you can put the source of reference, which I'll go through some point.
Yes.
Any question?
No questions so far. So
today lesson we learn about how we can sources of finance and how we can use them. We learn about ethics and we learn about stakeholders. So I will speak with you next week. Yes, and we will start anew, and I'll go through a bit, a 15-20 minutes how we can structure assignment as well. If you start your assignment, yes?
No, I'm planning to start for tomorrow because I was waiting to complete today because there was something is a link between 2 and 3 and 3 and 4 like this in assignment. That's why.
Okay, no problem. If you look here, if you need anything, ask me. I'll go through our, even Raman will help you as well, huh?
Yeah, sure. He's always there.
Okay, and have a nice time.
You told me you will be coming to Dubai next month. You are planning